What's the value of your business? Hey guys, I'm Chris Allman, and I'm here to get you equipped to exit. As we get started today, I'd like to ask you a question that I ask every single owner that I talk with when we begin building their exit strategy. And that is, what is the value of your business? So today we're going to answer the question, what is value? And it's important to understand that there are two very distinct measurements of value that apply to your business, and you need to really understand when it's relevant to use each one. So let's start by discussing the first and probably the most common measurement of value that you're familiar with. It's the one that I'm typically given as the answer when I ask the question, what is the value of your business? And I'm referring to your tax value. So your tax value is more than likely the number that you're used to seeing on your financial statements every month or every quarter, however often you're looking at them. And it's the number that your CPA and your accountant are always aware of because it typically impacts you each year financially, and they want to make sure that they're minimizing your taxes. So your tax value is typically determined by the fair market value of the assets and the liabilities of your business. So your taxes can be impacted by things like capital gains, depreciation, and other important tax factors. Your tax value plays a very significant role in how much your tax liability is each year. And even more importantly is it determines what your tax liability will be when you get ready to exit your business. When it comes to the tax value of your business, in most cases, the goal is to minimize the value of your business so that you pay less in taxes. Okay, so now that we have a good understanding of what the tax value is and why it's important, let's take a look at another measurement of value. That measurement is referred to as the real value of your business. So the real value of your business is essentially the thing that makes your business valuable to a buyer. Now, it could be intellectual property, it could be a proprietary system, it may even be a hard asset or piece of equipment. However, in most cases, the value of your business is derived from the cash flow or the benefit that the cash flow provides to your business. So this cash flow is typically referred to as EBITDA or EBITDA, which essentially stands for earnings before interest, taxes, depreciation, and amortization. So EBITDA is really widely accepted as kind of the standard for representing the cash flow that is generated by a business. Now, I'm not going to get into how to calculate your EBITDA or how to recast it. In other words, how to normalize it so that it's an accurate representation of your business and how it functions. But I do want to be aware of what it is and why you need to stay on top of that number. So if you aren't familiar with it or you're not sure how to calculate it, you should definitely consider asking your CPA if they can help you with that, or hiring a fractional CFO to assist you. It's definitely well worth it. So once you have your recasted EBITDA and it's in hand, this is really where the rubber hits the road. So this is where you find out how much someone is willing to pay you for your cash flow that your business is generating. Now, there are lots of rules of thumb or generalizations out there about what a buyer will pay for a business in your industry, but at the end of the day, it's going to come down to who the buyers are in the market and what they're looking for. So if you're near your exit, if it's very close and you're hoping to exit out within the next year or two, then you may want to work with a business broker or an M&A advisor to get a true gauge for what the market multiples will be for your business. But on the other hand, if your business isn't really at the position where you're ready to exit just yet, but you want to understand what your value is right now, and that way you can begin improving it, then there's some great tools out there, and you can really put together a good baseline for your business. So the way to do that is to first off determine what does a best-in-class business look like for your industry. So, as I said, there's plenty of resources out there, but if you don't know where to start, reach out to a business broker or an M&A advisor. Just tell them what you're looking for. Let them know that you're looking to get an idea of the valuations for companies in your industry because you're wanting to start growing the value of your business. So once you have that data on your business and you know kind of what best in class looks like and what the range of multiples are, then you want to compare your business to those best in class standards. So let's say that the rule of thumb says that in your industry, a business typically sells for 4 to 8 times EBITDA. So once you know that, now you want to compare your business to those best in class standards and ask, where do I fall on that range of multiples? Are you at the top and you're maybe going to get a 6.5, 7.5 times EBITDA? Or have you identified some of the areas that you really need to make some significant improvements in, and that might place you down towards the 4 to 5 times EBITDA range? So regardless of how much your business may be worth, according to these rules of thumbs or that general baseline that you've put together, it's more important to understand where you fall in that range. So it doesn't matter if you're worth 10 million or 6 million. What matters is that you know where you fall in that range. Are you towards the top end or towards the lower end? Because once you know that, now you know where to focus. So having that and understanding that you're in the middle or you're near the bottom, now you know what best in class looks like and you can start working on that. And you can use that as a way to keep you on track towards improving the value of your business. So if you focus on the areas that your business needs to improve in, then you're always going to be moving closer towards best in class. You're going to be increasing the multiple that you'll receive when you sell your business, and it's ultimately going to give you more opportunities to exit when you're ready and with the wealth that you need. So let's recap. When you talk about the value of your business, there are 2 distinct numbers to be aware of: your tax value and your real value. Now, the tax value, the goal for it is to keep it as low as possible so that you lower your tax liability. On the other hand, the goal for your real value is to grow it as quickly as possible and grow it as high as you possibly can so that it gives you more opportunities to exit your business with the wealth that you need. So now that you understand the difference between the tax value and your real value, what's the value of your business? As always, thanks for watching today's video. If you found it helpful, please hit that like and subscribe button or drop me a comment below. I'd love to chat with you about your business and the value that you have and what your exit strategy might look like. So thanks again, and I look forward to talking with you soon.